In this video, I'm going to go through a already completed budget that is for the quarter. And in doing that, I'm going to take this information. This is a static budget. And this is set up as a contribution margin income statement, which is important for management accounting, and that this way I can flex this budget, meaning I can change the quantity so that I can determine what is the effect on my operating income if I were to say increase my quantity by 1%, 10%, whatever it might be, or what is my break even? What is my, all kinds of questions that could be answered in using this type of format. But let's go through how we get this information. I am given all of this information above in my previous budgets that I've done. I'm just going to show you where this was given. We get cash when we issue stock. That was told at the beginning that you invested it. That you financed your business by issuing stock, and then you invested it by buying equipment. And then what we have is our purchases. Now, notice we didn't pay for all our purchases. How do we know how much our purchases are and how much we've paid versus how much we still owe? Well, we did that in a previous budget. If you take a look here, I'm going to see if I can get, yeah, here we go. You can see here that we purchased, this is the total purchases of inventory based on our sales for the quarter. So this is how much we had to purchase. What did we pay of that amount that we purchased of our inventory? If you notice here, we only paid $157,373. Well, where's the rest of it? Well, that's what we owe. The 5,000 expenses, that's the difference there, or 15,000 in total, we've already, or we pay in the month of or the quarter of. So all of this is paid. All this right here represents the amount we still owe for our inventory. This plus this should equal that, because your accounting equation needs to always balance. Likewise with our sales. Here's what we collected. Here's what we haven't collected of our total sales. Where am I getting my total sales? Well, from our sales budget that we did earlier in a previous module. In this particular example, my total sales for the quarter, price times the quantity. This is my total sales. How much of those sales did we actually collect? 231,603. How much have we not yet collected? 71,407. These two together equals this, and that's what my entry is. Sales, cash collected. Sorry, yeah, wrong one. Cash collected, and what I haven't yet collected. Cash collected and what I haven't yet collected. All right. Then, as far as when you make a sale, you also have to show that you've used inventory. Well, how do I know what my amount of my cost of my inventory is that I sold? That takes some work. Not a lot of work, but basically it is the number of units you sold. Well, how do I know how many units I sold? Well, we have that up above right here. Now I'm going to go equal minus that amount, because cost of goods sold, or my inventory is going down. What is the cost? I sold 60,602 right off my sales budget, but the cost of those I got to find. Well, what is our cost of our goods? $3 a piece, which I could also have gotten right here. So that is how you get your inventory that you used and expensed as cost of goods sold. It's the cost times the quantity. $3 cost, the quantity sold, right there. And then these are your other operating expenses, and then depreciation. Remember, when you do depreciation, It's your cost of your long-term asset equipment divided by how long you think you're going to use it. Now you got to be really careful here because this is a quarterly financial statement. So it's not a whole year or 1 month. It's 3/12 of a year. Okay, 3 months of the 12. So when you calculate this, I'll do it right here, equal minus again, because accumulated depreciation makes assets go down. So it's my cost divided by, and I'm going up here to see, well, how long am I going to use this for? It's 10 years. Now, if I hit enter, let me go ahead and hit enter. This is a whole year's worth of depreciation. I haven't had a whole year go by. So I'm going to multiply this. You can do it one of two ways. You can do it as a quarter, because this is a quarter, 1/4, or you could do 3/12. It's the same number. And that's how you get your depreciation. Then it's a matter of doing your financials like we've always done. Here's our income statement. If you need a review on that, your earlier modules 1 and 2 or module 1 will help with that. As well as, though this is a contribution margin income statement, we want our costs that will change with each additional unit. Cost of goods sold will change with each additional unit. These others are going to be the same, whether you make and sell 1 more unit or 10 more units or 1,000 more units. Those are fixed. So this, again, we are using a contribution margin income statement because we're going to vary this for different quantities to see what the impact is on our operating income and to do what's called a flexible budget. All right, cash flows. All those are right. Every time you see the word cash, that goes on our statement of cash flows. So those are all linked to our cash. Balance sheet is just tally up what you have. We got our cash, right off our cash flows, figure out your receivables, your inventory, your equipment, and accumulated depreciation. Here's your liabilities. And then shareholders' equity, it's your stock, and then retained earnings. This would be our retained earnings, which of course in this example, there was nothing mentioned about dividends. So it's appearing that we're retaining all our earnings. Make sure your balance sheet balances, take the difference and divide by 2 if you're off and look for that amount because maybe you left something out. Or excuse me, first take the difference and look for that amount. If you can't find it, take the difference and divide by 2 because maybe you added something when you should have subtracted. All right, here's really what I want to get to because this is essentially what you've done in earlier modules. This is a new format. And this is important for businesses. After the quarter's gone by, we're going to compare our budget to what actually occurred. So these are what actually occurred in the quarter. This is what we had budgeted to have happen. Well, how'd we do? Well, we're going to figure out the variance, but the variance doesn't make sense to take a budget based on this many units when the actual units sold were only like almost half. So here what's happened, we had a bad quarter. So what we have to do is in this flexible budget, I am going to take my, in fact, what you have here is this won't be given to you in these. You're going to take it and equal to what actually happened. And then if you recall, variable costs vary. So I'm going to calculate my new cost of goods sold. I'm not going to compare my actual to this. I'm going to compare it to what my cost of goods sold should have been, given that I sold 32,454, not had I sold 60,602. So this flexible budget is varying for the actual quantity so that I can then make these comparisons. That is what you're doing for your variance. And then you determine whether it's unfavorable or favorable. Was it a good result or a bad result? And that is a matter of looking at for revenues. If your flexible is greater than what actually happened, that's not good. In this case, we have favorable, we have a much higher actual revenue than what we should have had given the actual quantity sold. So notice these we varied. So does our contribution margin, and these are fixed. They don't vary. All right, and then as far as this is material that you should learn, should have learned and can refer back to Module 5, where you do your break even and your break even in sales dollars. All right, don't wait to the last minute on assignments. Leave yourself plenty of time.